Have you ever thought about the secret life of buildings? I'm not talking about ghosts or anything like that, but their secret financial life. Because in the world of accounting, a company's headquarters and a shopping mall it owns are two totally different things. One's a tool, the other's an investment. And today, we're going to crack the code on why that little difference tells you a whole lot about a company's strategy.
So let's just jump right in with a question. A company owns its head office, and it also owns a shopping mall that it rents out. Are they the same thing on the balance sheet? I mean, a building's a building, right? Well, in accounting, the answer is a big, fat no. And figuring out why it's a no is exactly what we're going to do. See, on one hand, you've got the company headquarters. That's part of the machinery of the business. It's where people show up to work. We call that owner-occupied. But on the other hand, you've got a property whose only job is to be a financial asset. It brings in rent checks, and hopefully its value goes up over time. Two buildings, but two completely different jobs.
This difference in purpose is so important, so fundamental, that it needs its own set of rules. And that's where International Accounting Standard 40, or IAS 40, comes into play. It's the official guidebook for how we deal with that second type of property, the one that's held purely as an investment. Okay, so first things first, we have to get the definition right. Before we can start applying any of the rules, we need to know exactly what counts as an investment property according to the standard. And here it is, straight from the source. The key here is the purpose. You're holding it to earn rent or for capital appreciation, which is really just a fancy way of saying you're hoping its value goes up. What's crucial is what you're not doing with it. You're not using it for your own business, and you're not trying to flip it for a quick sale.
Definitions are great and all, but let's make this a little more real. I mean, abstract rules are one thing, but seeing how they work in the real world is where it really clicks. So what kind of properties actually fit this description?
Well, the examples are actually pretty broad. It could just be a plot of land that a company is sitting on, waiting for the price to rise, or, more obviously, a building that's already being rented out. But here's an interesting one. Even a vacant building counts, as long as the plan is to lease it out. You could even be in the middle of building something that's intended to be an investment property later on. And just as important is knowing what's not on the list. So if you're a real estate developer building houses to sell, that's not investment property. That's just your inventory. And that corporate HQ or the factory we talked about? Nope, that's owner-occupied and has its own set of rules entirely. The standard draws a really clear line in the sand to keep these things separate. Okay, so we've figured out what an investment property is. The next logical step is, how do we value it on day one? What's the number that actually goes onto the balance sheet the moment you buy it? Luckily, the rule for day one is pretty straightforward. You record it at its cost. But, and this is a really important detail, cost isn't just the sticker price. It also includes all those extra fees you have to pay to get the deal done. Things like legal fees and property taxes. You have to bundle all of that into the initial number.
And now for what I think is the main event. Once that property is on the books, things get really interesting. Because IAS 40 gives companies a huge choice to make about how they're going to measure that property going forward. And this isn't just some boring accounting detail. This choice tells you a lot about how a company thinks about its assets. And the standard is crystal clear here. You can't just pick and choose for different properties. A company has to choose a lane, either the fair value model or the cost model, and stick with it for all of its investment properties. It's a major policy decision.
So let's break these two down. With the fair value model, it's all about right now. What's the property worth on the market today? Any change in that value, whether it goes up or down, hits the income statement directly. The cost model is, well, more traditional. You just stick with that original price and slowly write it down through depreciation. One reflects today's economic reality. The other is all about historical cost.
So, if you go with the fair value model, what happens to depreciation? How much do you have to record every year? The answer is zero. Zilch, nada. Why? Because you're already capturing any change in the building's value through that fair value adjustment. To also depreciate it would be like counting the same thing twice.
Of course, businesses don't stand still. Things are always changing. So what happens if a property's whole purpose changes? What if that headquarters we talked about is emptied out and the company decides to rent it out instead? Can you just switch it from owner-occupied to an investment property?
Well, the standard sets a pretty high bar for this. And the key word here is evidence.
A company can't just say, yeah, we're thinking about leasing this place out someday. There has to be a real concrete action, like they start marketing the property to find tenants. It's about actions, not just intentions.
Let's just walk through a quick example. So a company decides to lease out its old headquarters. First, they have to treat it under the old rules, right up to the exact day the use changes. Then, they get a revalue to see what its current market value is. Any difference between the old book value and this new fair value gets recorded as a revaluation. And from that day forward, it starts its new life as an investment property.
So, we've covered all these rules, definitions, models, transfers, but what's the big picture here? Why do we, as investors or analysts or just curious people, actually care about any of this?
Well, it all comes down to transparency. IAS 40 makes companies show you the important numbers. A disclosure might look something like this chart. They have to break out the key metrics, like how much rent is coming in, what their expenses are, and, this is a big one if they use the fair value model, any gains or losses just from the property's value changing. It's basically a performance report for their real estate portfolio.
And this right here is the crucial point. Following this accounting trail tells you a story about the company itself. By seeing how much investment property they hold, and especially which valuation model they choose, you get a real peek into their strategy. Are they a company that's just focused on their main business? Or are they also playing the game of being a real estate investor?
So the next time you're looking at a financial report and you see that line item, investment property, don't just gloss over it. Stop and ask yourself, what story is this number telling me about this company? Is this just a side gig for them, or is it a core part of their bigger plan? The answer to that question reveals the secret life of their buildings.